Good morning, everyone, and welcome to our Global Innovation Fund update. My name's John Woolley. I'm part of the sales and marketing team here at Amati, and we are joined this morning by the full innovation team. We have Mikhail, Graham, and Gareth. Thank you all for joining us. Now, it's just over 3 years since we launched the fund, and over that time, the team had generated very kind of healthy returns for investors. We're up around 27% since inception, which is great news. And just as a very quick recap on the fund, the team have quite a broad interpretation of innovation. This is definitely not a tech fund. It's much more broad and diversified than that. And what the team are looking to sort of identify themes and frontiers that are sort of real and happening now, but perhaps underappreciated and not in market consensus. Now, to do that, you need to do a little bit more digging, and the team may well talk about that and touch on it when we go through the presentation today. And then what you do is you kind of wrap that all in a framework of profitability, cash flow, and importantly, valuation disciplines. And what we come out with from all of that is a very differentiated conviction portfolio versus other tech, versus other innovation, and certainly versus most other global strategies. This is definitely not a Mag 7 mega cap tech fund that we're giving you here. But we kind of see that as hopefully being pretty helpful and useful in terms of investors being able to construct portfolios for their clients. Now, what has been consistent throughout the whole period since inception is the process and approach. There's no doubt about that. Less so, you would say, about world markets. That's definitely not been. There's been a fair bit going on. We have an AI boom going on. We have Trump then coming onto the scenes and causing all of that havoc. So what the team are looking to do, and we'll run through today, is explain how you kind of approach all this when running the strategy, by focusing on what they see as being what we call the technologically inevitable. So the team will talk through some of those innovation frontiers and themes which are in the fund, and then give you a bit more flavor for all those really exciting other themes that we also have in the fund. And then when we kind of wrap it up, we'll have a Q&A session. Please do submit your questions, and we will look to deal with those as many as we can at the end of the presentation. But for now, I'll pass over to Mikhail.
Thanks very much, John. And my understanding is that we have a mix in the audience of people who know us well and followed us for a while. And so we'll focus for those more on what's been happening in the portfolio, what are the more interesting things we're looking at going forward. But also for a few people who are relatively new to the story, I wanted to just do a quick recap. I mean, John's done a fair bit of my work for me already, but just to reiterate, the key features of our fund are here. We invest in what we call pioneers, enablers, and adopters of innovation. We'll expand on that very important classification in a couple of slides. We think the opportunity is very compelling. Innovation creates a lot of value, but it's mispriced. Its market is not efficient. Its market is often put off, or is not well equipped to understand the complexity, the uncertainty, the inflection points associated with innovation. And by focusing on that, we can capture that opportunity. We can capture that in efficiency and generate returns for our clients. To do that, we embrace a range of disciplines. One is we're very comfortable with complexity. Some of these innovation companies are engaged in very interesting technical areas, and we tackle that. We think that's where some of our opportunity is. But we combine that with a focus on valuation, profitability, and cash generation. We sometimes call it we invest in real businesses, not science projects. And between us, we worked through a number of cycles. In fact, Graham and I worked in the industry through the dot-com one and many subsequent booms and corrections in the innovation space. And we know that having that financial discipline, investing in companies in charge of their own destiny, is how you capture the innovation in the long run. And then between the three of us, I think we have an edge, and we're working hard to deepen that edge in understanding this innovation investment cases. We have over 60 years of investment experience. This is a rather depressing number, but we do. We have a couple of top quartile track records in running global equities over the long periods of time. We have academic and professional backgrounds in technology, semiconductors, and biotech and aerospace that are helpful in tackling some of this. And the way we research things, the way we build networks among smaller companies using our Amati connections, but also reaching out into the industry, going to trade shows, doing that deeper digging that John's alluded to, also consistently gives us a bit more information, a bit more understanding than an average global investor might have. And the result of that is a portfolio that is very different from benchmark and is very different from a number of our global equity peers.
Yeah, and again, briefly for those of you who are new to the fund, as John mentioned, it is definitely not a technology-only fund. It's an innovation fund. So the intention is to go, wherever we find the impact of the innovation is best rewarded. So there are 6 sectors at the moment covered in the portfolio, and we really can go anywhere, regardless of sector or geography, with a few small caveats on geography. It's very differentiated to a lot of other sort of global funds that you'll come across. We don't have a large cap bias, as John mentioned. We're really looking for beneficiaries of very specific innovations. So these tend to be more in the sort of mid-sized companies rather than the Amazons and the Microsofts of the world. So we don't have any of the Magnificent Seven, as they're called, on the portfolio at the moment, and we're unlikely to have. Valuation discipline is very important to us. As Mikhail said, we've worked and lived through various cycles in the market. It's always important to understand what you're paying for when you buy a stock. And when you're buying innovation, particularly, it's important to buy real companies, not science projects. So every company experiences something of a cycle, regardless of what they do, whether it's economic or just industry cycles. So if we're buying companies, we want them to be cash generative and have strong balance sheets and be profitable through that cycle. And we don't want to overpay. So valuation is very important. We'll talk a bit more about that later. Focus and conviction, 40 holdings. We can hold up to 40 stocks. We think that's the right sort of balance of some diversity, but also sufficient concentration to make each stock matter. And lastly, we are very different. It says highly active. That doesn't mean we trade a lot. That means we're very different from the benchmark and from our peer group. So 98% active share, we really have 2% crossover, if you like, with the benchmark. So very, very different.
A few words on our process. We have a very rigorous, what we might describe as an institutional grade investment approach. Both Graham and I, in our prior careers as portfolio managers, grew up in the institutional investment world, where we think it's really important to understand exactly what is the market inefficiency you're exploiting, how you've built the process to capture that inefficiency for your clients, and kind of demonstrate the rigor and consistency in that. And that's exactly what we're doing here. Everything we own has to pass through this 4 hurdles, this 4 tests. We start with innovation, or what we sometimes call innovation frontier, an area of innovation that's really differentiated, that creates real economic value, that tackles a set of problems for a large market, and that has clear evidence of adoption. That technological inevitability that we referred to. We don't imagine the world how it might be, exciting as it might be, but we'll look for something that's already making a difference for the industry, is adopted, and we just ride that adoption curve. So that's step number 1. When that innovation test is passed, we map out what we sometimes refer to as an innovation cluster. What are the companies that participate in that? And we look at those in a very consistent framework. Which of them will benefit from this innovation in the most material way? Which of them have a proven track record of developing and commercializing that innovation? And which of those companies have the best business model with profitable growth and cash generation? So effectively, pick impactful innovation, pick the best business model within that cluster that benefits from that innovation. Make sure it's sustainably run. We're not an ESG focused or impact fund, but we take things very seriously. We do this work in house. We do this work very specific to the businesses we look at, and we add an extra dimension of human rights. We use a Freedom House methodology to assess the civil and political liberties in the countries where our companies are based, and we do not invest in countries which are non-free. And at this point, it does include China. We cannot invest in China because we think the risks, political and civil risks associated with that, are too high for our clients in the long run. And last but not least, a non-consensus test. We model what this innovation means for the business. We take a 3 to 5 year time horizon, fairly long term, but pragmatic, not futurist. And we make sure that our vision, our view on what this innovation means for the business is sufficiently different from consensus. And that's where valuation discipline comes into play. Whether it's what's in the broker's numbers, in the consensus sell side forecast, or what's implied in the valuation multiple, we want to make sure that our view on the future is sufficiently different from what's already priced in. So that workflow, impactful innovation, best business models within that, sustainably run businesses and attractively valued really defines our investment approach.
And when we research across the innovation value chain, we come across three broad categories of companies, three broad categories of innovation beneficiary, and those are pioneer, enablers, and adopters of innovation. And so, respectively, those are the creators of innovation, then those companies that support them, so those that enable the innovation with tools and services, and then finally the lateral beneficiaries of innovation, so those that apply the innovation to their businesses once it's more mature. And so this approach helps us broaden our opportunity set. It helps us identify the optimal risk and reward, and it aids in portfolio diversification. And that's really best illustrated with an example. And this is a snapshot of our advanced testing and diagnostics innovation frontier from when we first launched the fund. And so think of this frontier like COVID-19 testing, but for every disease and also your health status. And when we started analyzing the innovation value chain, we found that one pioneer, Illumina in this case, had more than any other company really driven forward DNA sequencing and its progress over the last 2 decades. So over the last 20 years, the cost of sequencing a human genome has gone from more than $13 billion down to just $500. And that's caused an explosion in diagnostic testing. But then if you go across the innovation value chain, you come into enablers in this frontier. So those are companies like QIAGEN, and they provide consumables for preparing patient samples ready for testing and provide software to analyze the test results. And in fact, QIAGEN is a global leader in these two areas. Then in the adopter camp, you have companies like LabCorp. They have vast testing networks, and importantly, they have access to doctors and patients and testing locations. So really, they own the channel to the end user, and they can create very sticky customer relationships because of their network, so that when a customer thinks of testing, they automatically think of LabCorp. And so when we first looked at this frontier, Illumina was, the leading pioneer, but it had a single technology risk and it had a very high valuation, while the enablers and the adopters had much more diversified business models and more attractive valuations. And we chose them over as our holdings over the pioneer. And both LabCorp and QIAGEN have significantly outperformed Illumina since fund launch. And this helps illustrate kind of the key advantage of our pioneer, enabler, and adopter approach at the portfolio level, because it helps us have a more balanced approach through the cycle. So when pioneers are too expensive in this case, we can find enablers and adopters and pivot back once those pioneers are less in favor.
We're going to spend the rest of the presentation, or some of the rest of the presentation, talking more about current portfolio positioning and where do we see opportunities going forward, and kind of responding to our presentation title, looking for the technological inevitability in this very uncertain times. And I'm going to start. The three examples that we're going to go a bit deeper on are significant exposure for the portfolio, and place we've been adding capital, sometimes taking advantage of the recent weaknesses in the share prices. And this particular one is, you could call it a bit contrarian. The EVs as a thematic have been very popular in sort of 2020, 21, and really kind of lost favor with investors over the past year or so. And some of that is fundamental recognition that we've exhausted some of the early enthusiasm for early adopters of EVs. A lot of that was concerned that both the sort of subsidy incentive programs that stimulated some of the EV demand have been cancelled or scaled back, and also the macroeconomic environment is a bit more uncertain. And ultimately, buying EV is buying a car, and that's a big consumer decision. Consumers tend to delay those in less certain environments. But we think electrification is technologically inevitable, and it continues, even if sometimes it continues by stealth. And if you look at the right side of this chart, some of this this very small figure of an individual presenting in front of a very large screen is a great illustration of that. Electrification isn't just about pure battery EVs; it's about hybridization as well. So we're familiar with the plug-in hybrids. There's a new category which has been hugely successful in China and is coming to the Western markets called extended range hybrids. And this is where you combine effectively a generator with the battery, and you achieve ranges like, for this Xpeng model, for example, 1.4 thousand kilometers. There are cars that do 2,000 kilometer ranges. So really much, there's no range anxiety here. There's much longer range than anything, a diesel car can do. The battery technology continues to progress. We've seen pretty spectacular performance numbers from some of the recent versions of batteries, and they're cheaper as well because they're using slightly different battery chemistry. And then you also have a new acronym for us to learn, XBW, which stands for X by wire. So the functions of steering, power steering, and braking, as well as the actual propulsion, as well as actual traction, are moving from hydraulics and mechanics to electrics. So you're, as you know, in some of the drive-by-wire cars, when you move the steering wheel, it actually doesn't have any physical connection to the actual wheels anymore. It's basically sending a signal, and the algorithm turns the wheels just the right way for the speed and conditions. And you have this pretty interesting consumer propositions where some of these new cars, and this is real, this is happening, can literally shuffle sideways into a parking spot, for example. So you don't have to parallel park anymore, or you can spin on a dime, so you don't need to do 3-point turns. So the consumer proposition of that is becoming really compelling. And so the supply chain of this electrification is a very complex space. We dug through it in a lot of detail. We've arrived to 4 areas which actually are oligopolistic, disciplined industries with some really great companies, very profitable, very cash generative, top of their game with very strong market share positions. And some of them are pretty prosaic, like connectors, where we own American Amphenol, or passive electronic components, capacitors and resistors and things like that, where we own Taiwanese listed Yageo. But some of them are very high tech. For example, in power semiconductors, the smart devices that are managing the power on the car, Infineon continues to be the dominant leader and is gaining all that benefit of electrification by stealth or otherwise. And then all this electrical movements, rotations, actuations, etc., require sensors to measure speed, angle, and currents flowing through the circuitry. And Allegro, a US-listed mid-cap company, is a dominant leader in that sensor space. All of these companies are profitable, cash generative, and have very strong balance sheets.
Moving on to radiopharmaceuticals from parallel parking. So radiopharmaceuticals are a form of precision medicine, but really it's precision medicine gone nuclear. So what you're doing here is you're delivering a radioisotope, so something that is radioactive, but only to a very specific target. And so this can be used to kind of light up a tumor, so to see it for radiodiagnostic, or to deliver enough radiation to kill it for radiotherapy. And so their structure, the best way to kind of picture it is like a missile and a warhead. So your warhead is the radioactive isotope, and the missile is the molecule that only homes in on a very specific target. So something like an antibody, and this leads to fantastic benefits to patients. So fewer side effects from treatment and much better outcomes. And when we looked across the innovation value chain, we saw 2 very clear standout companies. The first of which is Eckert Ziegler, which is a German listed enabler, and it's the leading specialist really in the manufacture and supply of radiodiagnostics, and it's unique in being an end-to-end service provider. So it will not only produce you the isotopes, it would also manage the waste after you've used them as well. And it's benefiting from kind of the ever-growing demand, but still the constrained supply of isotopes. And because of this, it can sign very long-term supply agreements with customers. So this can be up to 10 years on very attractive terms. And then secondly there, you have Telix, which is an Australian listed pioneer. It has one of the leading radio diagnostics for prostate cancer, and it has a second generation version already approved and launched. It's also developing a very broad pipeline of other radio diagnostics, and it has a promising pipeline of radiotherapies. But a key part of its business model is its vertical integration. And so it's able to produce, manufacture and deliver products to patients, and that gives it an added resilience, but also additional revenue streams compared to its peers.
And then going from pharmaceutical warheads and payloads to actual warheads and payloads in the defense sector. This is a sector we've been invested in since the beginning of the portfolio. And it's an area where we do find a lot of really interesting innovation. Unfortunate to say, really, in a sense, but there's a lot going on here, and I'll try and cover some of it very briefly. But the background to this, obviously, as many of you will know, is that defense spending has been, particularly across the NATO countries, really under-indexed by most of the countries for the last 2 decades, really. And that's changing now. You see a lot of headlines out of countries like Germany and the UK and others about getting defense spending up to more reasonable levels. And that's a kind of background, if you like, to the spending that we see in this space. But there are lots of other things that are going on, and the governments are looking for innovation to kind of take up some of the mantle for the development of new technologies and new ways of facing what is really a changing nature of warfare. 3 areas that we particularly focus on where defense does play a significant role, and have been highlighted in a lot of the strategic defense reviews from the different nations, are areas of drone and anti-drone, space and cyber warfare. And each of those really has very large technological inevitability to them. The pictures you can see on the right-hand side, the top one there is supposed to sort of show an operations room and really just give a picture of cyber intelligence. One of the companies on the portfolio, Booz Allen Hamilton, is a US service company that offers a lot of services into traditionally the sort of 3-letter agencies, the CIAs, FBIs, etc., as well as directly into the Department of Defense. There's a huge amount going on behind the scenes in cyber. We hear some of it in the press, but when you talk to analysts and people in the industry, it's just an area of constant focus at sort of national level. So a lot of spending going here. Drone and anti-drone. The middle picture you can see is a picture of it's a Stryker armored vehicle, and sitting on top of that is an M-SHORAD platform, which is made by Leonardo DRS, which is one of the companies we hold on the portfolio as well, and have held actually since pretty much the start of the fund. And it's just, I think, coming up to made 5 times return on that stock since we bought it, which is very impressive, I think, for a defense company. And on top of that M-SHORAD platform is a turret, a weapons turret made by another company on that list there, Moog, which is an enabler that makes components that go into a lot of these kind of systems. So we've got good exposure to that area, which is really focused on particularly anti-drone warfare. So coming up with new weapons to take drones out of the sky in particular, and not just projectiles, but also increasingly using lasers and other technologies. And the last one on the list there at the bottom, you can see a picture of supposed to be a space operations, really. L3Harris, the company we own on the portfolio, makes a lot of equipment that is increasingly being used in space. So things like sensors and detectors that are used for missile detection. L3Harris is in hot contention, for example, for the kind of much vaunted Golden Dome initiative in the US, which is supposed to be a national missile defense strategy. So, there's a lot of spending going into these different areas, despite the fact that we're seeing governments, particularly the US government, with some of their initiatives to sort of cut spending. We're still seeing a lot of focus on defense, and sad to say, but very important area of investment for nations, we think, for the next decade or so, and we're quite well positioned there.
So we've given you a bit of a deep dive into our innovation frontiers and some of our companies, but what does the portfolio look like at the aggregate level? Well, it's highly diversified. We have a prominent exposure to the US, but as we've highlighted through our stock examples, we have plenty of differentiated ideas in Europe and Asia. The three biggest sectors, as we have covered in the portfolio, are tech, healthcare, and industrials. Kind of areas where you'd expect a lot of innovation, but we have a total of 6 sectors, including financials, consumer discretionary, and materials. We have more than 60% of the fund that is a sub 25 billion market cap in size, but it's a genuine all cap portfolio which can go anywhere. And then something we've mentioned a couple of times is the pioneer, enabler, and adopter mix, something that has changed over time, which enables the portfolio to flex through the cycle. So when we first started, we had fewer pioneers because they were still, in our view, overpriced from the kind of 2021 boom years. But that part of the portfolio has grown over time as those valuations and expectations have moderated.
This pie chart is probably the best way to describe our portfolio positioning. So we talk about this innovation frontiers, areas of this very tangible, very value creating innovation that some companies will really benefit from, and this kind of more fragmented outer wheel of this fairly complex picture shows all the innovation frontiers currently in the portfolio, and we've covered some of them, but you can just see the granularity of the sort of the fact that this is something we discover from the bottom up, and we hope a degree of non-consensus. You probably don't hear everybody talking to you about multiomics as a new diagnostic sort of and drug discovery framework, or talk to you about bioprocessing as a kind of a tectonic shift in how medicines are being manufactured and will be manufactured going forward. But just to give you a sense of the diversity and the granularity of the work that goes on, as well as the companies associated with that. Some of this are larger, so we maybe have 3 or 4 companies participating in that frontier. Some of that are maybe just single stock that we deemed to be the best business model to benefit from this innovation and change. But we're also cognizant that there are some very big, what we call growth tailwinds, areas of structural change like geopolitical change or aging population, and that creates the demand and the scientific progress that creates supply of healthcare innovation. And we're very cognizant of those tailwinds, but we're also cognizant that we're not going to be the first ones to tell you about it. That's not where our non-consensus lies. Where we add value is really this granular bottom-up discovery of innovation frontiers.
Just very briefly, a snapshot of the portfolio fundamentals. We said at the start about the importance of valuation discipline and focus on real companies, not science projects, strong balance sheets, strong free cash flow generation. And you can see some of those statistics on there. We do trade at the average for the portfolio is a little bit higher P ratio than for the benchmark, as you can see. But for that, you're getting much higher EPS growth. And these are consensus numbers. These are not our estimates, which are typically higher than consensus. But for that, you're also getting a free cash flow yield, which is broadly similar to the benchmark, despite the fact that we don't own areas like, utilities and some sort of less innovative sectors of the market that tend to have high sort of cash generation. So we're very proud of that free cash flow number. And balance sheets, you can see our net debt to EBITDA, the leverage of our companies is lower than the average for the benchmark. So these are very sustainable businesses, which we're confident will perform well through the cycle and will be there. If we get difficulties in economic outlook, these companies they're in charge of their own destinies and will be there to thrive and flourish as we come through the other side of any weakness. And just that last point about market cap, we are very different from the average from the benchmark. The average for the MSCI World now is, as you can see, almost 650 billion. We're much smaller than that, but still very liquid companies, sort of 55 billion or so is our average market cap.
We're also very different from a number of our peers. We don't run the fund with one eye on the competition, but we wanted to build something that is quite differentiated and gives our clients something that they can't readily get already And I think we have that. If you look at our overlap with our choice of our global equity peers, which are really well respected, well recognized general purpose global funds, we have virtually no overlap, maybe one or two names at best, a few percentage points. But interestingly, we also have very little overlap with some of our leading peers in the innovation space. And the difference there is mostly we're not heavily biased towards the large cap tech, which a lot of our innovation fund peers are very, very strongly biased towards. And we're also, bring this valuation and profitability and cash generation discipline, which is not common in our industry. We buy real businesses, not science projects. It means we will occasionally miss, a spectacular futuristic idea that one day will come good, but we also think we'll miss a lot of disappointments and a lot of financial distress that comes with companies that have not yet achieved sustained profitability. So that's our cut on the innovation opportunity. It makes us quite different from players like ARC or a few others like that. Just a few over the next couple of pages. We'll give you a quick overview of the past year or so, both in terms of what's happened and our take on it very briefly. Some of this will be very familiar, of course, to you, but also what it meant in terms of market performance and market behavior, and how the fund navigated that environment. Starting with the AI boom that needs no introduction, has really been a defining characteristic of the market, especially in technology space. We did own NVIDIA in the beginning of the fund. We sold it early. Our non-consensus discipline sometimes really works against us because we find it really important to prove to ourselves that we know something, we think something market doesn't already think. And a lot of current exuberance around AI is yet to be proven right. This is one of those investment adages. If it's not a hell yes, it's a no. We find more technologically inevitable things out there to back with our clients' capital than joining this slightly speculative debate as to whether or not we will achieve artificial superior intelligence, which justifies a lot of this spectacular investment in AI capacity that goes on at the moment. We talked about EV pause. Again, this is where we're taking a bit of a contrarian view. Market has been very down on a vehicle electrification space, and we found some really interesting undiscovered opportunities which we're backing through this uncertainty.
Yeah, industrial down cycle, people may or may not be aware, but obviously the uncertainties caused by the US election and sort of the move to higher interest rates last year did cause some delays to spending across a lot of industries. And that was made worse, obviously, by the introduction of this big focus on trade tariffs by President Trump. So we have been through a period of just delayed spending and decision-making by big industrial companies, particularly. We're exposed somewhat across areas like, again, specialist areas like warehouse automation and logistics, which we, again, see as being inevitable and huge areas of growth and spending over time. But we've seen a bit of a hiatus over the last sort of year, 6 months to a year. Geopolitical instability probably needs no discussion, really. I mean, our exposure here, we mentioned Leonardo DRS earlier, which has done very well. We also owned a German company that's a sub-supplier to the kind of tank, battlefield equipment, armored vehicles market, an electrification player called Renk, which, rather like the comment about AI, we sold it after we doubled our money and felt the market was up to speed with the valuation. And in fact, it's carried on going up. And we just think valuations are starting to get very stretched now for what's sort of becoming a bit of a meme investment area, we think. But you need to pick your spots and be confident about what you're investing in.
And on the life sciences slowdown, so after kind of the COVID boom years where everything in life sciences just went up, that was clearly unsustainable. You had a normalization of investment levels within the industry, and a drop in the demand, and that led to a very extended inventory correction. And last year you saw widespread employee reductions, and also quite a steep retraction in venture capital funding of early stage companies, which has kind of depressed the industry further. And then more recently you have political uncertainty. That's caused a further pause in demand, and the kind of industry is waiting for a clearer picture in terms of manufacturing and drug pricing and science funding. So not a short list to resolve.
Yeah, and the U.S. policy, trade and otherwise, have been just an accelerant to this uncertainty in a way. Whether it is delaying big industrial capex decisions further, or casting some doubt on funding for NIH or major research universities. It gives investors more reasons to stay on the sidelines. And for us, if you pick a technologically inevitable innovation vector, innovation frontier within that space, it allows us to get involved with these companies at more attractive price. So it's been, we found ourselves being a little bit more contrarian over the past 6 to 9 months, which so far has been a bit of a headwind to our performance. But we see, this, uncertainty and volatility can be an opportunity, and this is very much the case at this moment. And if you look at how the markets performed in response to that, some of that needs no introduction, but probably just to highlight the magnitude of that. Since the beginning of 24 up until now, Magnificent Seven continued to dramatically outperform the market, and that's after a spectacular year of outperformance in 2023. So you can see that here, Magnificent Seven had become a safe trade. We remember the time when Nestle's and Unilevers of this world were places where people went when they wanted a bit of growth they can rely on. And now it's Amazon and Alphabet and Meta that I think have that status with a bit of an AI magic dust on top of them. Round about the election, when it became clear that Trump, with very pro-business policies, is winning the US election, and then he won the US election, we had the spectacular rally in risk appetite. We use UBS profitless tech basket, something we don't invest in by definition, as a measure of markets' willingness. But you've seen that in crypto, you've seen this in other kind of high risk areas. You had this really big rally and then very rapid correction, a bit of a rally since then. It just sort of highlights the factor volatility within the market that goes on in response to these events. And to some extent, you see the same thing in cyclicals versus defensives. You had, when it became clear that Trump isn't as well, it is the policy is pro-business, but the implementation of the policy has been a source of volatility and uncertainty for the business. And so there was a big risk-off trade with cyclicals really collapsing into kind of April post-Liberation Day, and then recovering somewhat, but not completely. So this, on average, this represented a bit of a headwind for us. If you think about what we do, we are not Magnificent Seven. So Magnificent Seven outperformance has been a very significant headwind for us in relative performance terms, if not, although not in absolute, for the duration of the fund's life. We ignore profitless tech. We want our companies to be real businesses, not science projects. Okay, we don't ignore it, but we study it, but we cautiously avoid it. And of course, that rally in profitless tech has been a headwind as well. And we are somewhat pro-cyclical in our stance. Our companies innovate as part of investing in new capacity, as part of launching new products. These are not defensive businesses. These are companies kind of on the front foot when it comes to economic growth and investment. And markets risk aversion and uncertainty tends to be a bit of a headwind for us. And so if you look at our performance up until the summer last year, this is the golden line is the performance of the fund, 27% since launch, or since fully funded, when all the seed capital has been fully invested. We lagged the MSCI All Country World Index by some margin because we didn't have that Magnificent Seven exposure by design. It's almost entirely explained by that. We significantly outperformed MSCI All Country World Equal Weighted, which eliminates that size effect, if you like. And up until the summer last year, we were very proud of the fact that we were keeping up with the market despite not having any of that Magnificent Seven help. But this selection of more pro-cyclical contrarian views that we've taken and backed with our clients' capital has been a headwind since then. So we kind of lagged a bit since then. We think this is where we will make our investors money over the next 3 years. This is where we've found some technologically inevitable opportunities, in our opinion, that are priced very attractively because markets concerned about Trump health policy because Mark is concerned about Trump's trade policy, and Mark is not yet believing in any positive outcomes that Trump policies might bring. We have clear non-consensus view on many of those things, and we're backing our view on the 3 to 5 year time horizon. I'm probably should be conscious of time, but we just wanted to give you a sense of what we're looking at the moment. These are not ideas in the portfolio yet, but these are what we call big open questions that we're currently working on, our research pipeline, if you like. And we'll just give you a couple of sentences on each, just to give you a sense of what we're spending a lot of our research time pondering. One of them is, again, AI related, but with a bit of a nuance. Most of the AI we've seen so far is happening in the cloud. There's massive models answering your questions on ChatGPT apps, etc. But a lot of the use of AI is going to be on the edge, from smaller models running on your phone. Apple Intelligence is an early taster of that, to tiny little models that run predictive maintenance on a piece of industrial equipment, or even a remote sensor somewhere. And we're spending a lot of time trying to figure out who will win from that. Will it be still NVIDIA benefiting from this? Will it be a smaller silicon players, more specialist semiconductor players that will benefit from that? So this move of AI from cloud to the edge, as the industry calls it, is one of those big questions we're pondering.
And for PET imaging in diagnostics, so first of all, what is PET? Well, it's just kind of any other imaging method like an X-ray or an MRI, but it's a way to image radioactive diagnostics. And since I've mentioned them more than twice in this talk, you can probably tell that I quite like them a lot. But what it does is it delivers a much clearer signal about a patient's disease. And so, doctors and hospitals really see these as clinically transformational, and the wider and deeper use of PET imaging is really technologically inevitable. So kind of the questions that we're pondering at the moment are around, where does PET imaging go? There's hints that it moves into Alzheimer's disease diagnosis much more broadly, and that is a huge unmet need in a large patient population. So we're thinking about how quickly could that grow, where else could it move into, and where in the innovation value chain will it benefit the most?
Nuclear has been a really interesting area for us to think about, really, since we started the portfolio and before that. But we just see it as a sort of inevitable technology, in the sense that it's carbon free, it's renewable, it's consistent baseload power. But more recently, we're having a lot of changes to the industry, the development of things like small modular reactors, even changes in technology away from the sort of light water reactors of the past and that are still being built, towards new areas like thorium salt reactors. So there are technology changes and sort of demand changes here. Getting ahead of it is difficult, in the sense that these are typically very long duration projects, and often beyond the scope of our investment horizon, which is sort of 3 to 5 years. So we really like the sector. We're constantly looking at ways to invest in it, but it remains a bit of an open question for us.
I'm just going to suggest, if you guys are okay with that we will maybe move on to closer to the Q&A, just in the interest of time, to not to test our audience patience too much, but we'd be delighted to talk to you in person or one-on-one on Teams or otherwise, to tell you about more of the things we're working on, and of course other things in our portfolio. But before we do that, maybe just over to Graham to give you a sense of the sort of work we do as we explore these opportunities.
Yeah, very briefly. I mean, this was just sort of meant to be, to some extent, a bit of a fun slide, but it sort of demonstrates that a lot of the research we do is quite granular again. So we do obviously go to investor conferences and meet companies along with other investors, but we also spend a lot of time at trade shows and trade fairs, because getting out to these sort of drafty, exhibition halls has a lot of benefit. We get to talk to the engineers who work on these products. We get to see the companies in their own kind of environment, and the competitors they're facing, and the suppliers that they talk to. And talking to just the practitioners in the industry gives us detail in these companies that we just can't get anywhere else. So it is an important part of our investment process to get out on the road and go to these trade shows, and we'll continue to do that.
So if you need a recommendation for a good curry house in Birmingham near NEC, or a good place to get a pretzel in Hanover, then please let us know. We've got some tips on that. So maybe just to summarize, we think the opportunity we're pursuing is really compelling. It creates a lot of value. Innovation creates a lot of value, but it's mispriced. So you can get a good deal, as President Trump would say, if you dig hard enough, and that's exactly the opportunity we're pursuing. We do that with a set of disciplines that somewhat set us aside from many of our peers. We're happy to tackle complex subjects. We embrace that complexity, but we combine that with our focus on valuation discipline, profitability, and cash generation. Real businesses, not science projects, and looking for technologically inevitable innovation, not a somewhat futuristic vision of the future. And we're working hard to deepen the edge that we have. We have experience and academic backgrounds in subjects that help us. We have past track records of making our investors money, but we love doing the deep work that is required, in our opinion, to get better understanding of this innovation opportunity, and go off the beaten track compared to where many other investors are willing to go. And the result of that is high conviction, differentiated global portfolio, investing in this innovation opportunities in a very complementary fit for our clients. Very different from the benchmark, very different from many of our peers, and delivering returns. We are ahead of our Morningstar peer group since we launched by 2.5 percentage points per annum as of today. And this is a very strong result given we've overcome that headwind of not owning any Magnificent Seven by design. So with that, thanks for your patience, and I will pass it on to John for the Q&A.
Thank you. Thanks all. Great update on the fund. And we have a few questions. We'll get through a few of these. We don't have time to get to your question. We will come back to you after the event. But on the first one, noticed you've got 30% exposure to Europe. So you have a question here about, are you thinking shifting more to Europe from the US?
It's really very much a bottom-up decision. So we don't make that decision, should we transition to Europe from the US? We look at, again, very granular innovation areas, and then we'll go wherever the kind of that innovation cluster research takes us. So, in the case of radiopharmaceuticals, obviously we found a lot of those businesses to be European based, and but in defense sector, there are a lot of companies in the US, for example, although we have obviously had Rank, a European company. So it's really dependent on where we're seeing the innovation and which companies are best positioned to benefit. It's not a top-down decision.
Okay, great. We have a question here. For the reasons explained, the fund does not invest in China. Does the fund have holdings in Israel?
The simple answer is no. We don't have any Israeli listed companies. Israel qualifies from the Freedom House perspective under our ESGH framework. We're worried about the geopolitical risks, obviously, in many different ways in relation to Israel. Some of our companies have operations in Israel. I mean, most US tech companies, including NVIDIA, do. So that's a factor we consider, but no Israeli listed companies at the moment.
Brilliant. Thanks, Mikhail. Look, we couldn't go without a question on AI. So the question is, which companies or industries will be losers from AI, and how are you reflecting that in the portfolio?
Yeah, that's a good question. I mean, it's still very early days. We think AI is a fantastic, and a massive change to the way the world's going to operate and the industries will operate. But at this stage, the things that are evident, AI is very good. Generative AI is very good at coding and creating code from just human interaction, speech interaction. So you can try this yourself, actually, with a lot of the products. Gemini is a good one. ChatGPT obviously is another one you can try, but just ask it to help you to build a program, and you'll see that very quickly, just by telling it what you want it to do, it can create software for you. And so if you're a company that has, a relatively generic sort of software as a service income stream that you're relying on for a long time, you're going to want to worry about that, because there's going to be more competition than companies looking to do it themselves using AI. I mean, other areas, if you're a company that has a lot of staff that do relatively low value added work like call centers, these kind of things, they're at risk, I think, from AI agents. Agentic AI is really just taking off hugely at the moment. And I think largely, every company should be using it, AI now. And if you're not, if you're a business that's not thinking about it and using it, the likelihood is that you're going to be superseded by another company that does something similar, but is either AI native or is using it more efficiently and effectively than you are. So it's something we care about when we look at companies.
Good. Thanks, Graham. Well, thank you, team, for the update. Thank you, everyone, for taking the time and effort to dial in and listen today. Very much appreciated. Hopefully you found it enjoyable, insightful. And on the page here in front, you can see all your kind of sales contacts here at Amati. Any further questions that come to mind, please do follow up with. And as Mikhail and Graham said, all the team, are more than happy to talk anything, innovation at any point. So please do get in touch. Once again, thank you for taking the time to join us.